Welcome to the Deep Dive. Today we are jumping straight into a really fascinating divergence that came out of a major U.S. financial institution's Q4 2025 earnings call.
It's a classic, isn't it? You had the management team on the call just painting this incredible picture of transformation.
Absolutely. They were talking about ambitious new targets, finally getting out from under years of regulatory issues.
They sounded so confident, but then you look at the market, and the initial verdict was not great. Shares dropped pretty sharply.
And that's the core conflict, right? It's narrative versus the numbers. The company's basically arguing, look, we're finally on a level playing field. It's growth mode from here on out.
But on the day, investors just couldn't look past that near-term revenue softness.
So that's our mission in this deep dive. We're going to sort through all of it, the numbers, the management commentary, the hidden risks, to really understand the trade-offs they're making.
Exactly. Is this just a temporary dip before a huge takeoff, or is management, maybe overpromising a little? It's really a battle between interest rate jitters and the long-term power of efficiency.
Okay, so let's start right there with the numbers that caused all that anxiety. The headline, GAAP earnings per share, or EPS, came in at $1.62.
And the street was looking for $1.67, so a miss.
A miss. And revenue didn't do them any favors either. It landed at about $21.3 billion, also short of the roughly $21.7 billion estimate.
And then the big one for any bank, net interest income, NII, also missed. So you've got 3 headline misses. It's not a great look.
It really isn't. But this is where you have to read the fine print, because the story changes when you look at the adjusted figures.
It completely changes.
Yeah.
On a non-GAAP adjusted basis, they actually reported $1.76 EPS. That beat the consensus by 7 cents.
So what explains that huge swing from a miss to a beat?
It was all down to this massive one-time severance charge, a pre-tax hit of $612 million. Yeah, that works out to about 14 cents a share. And this is the key part. This wasn't about cleaning up old messes. This was a cost they took now for actions they're going to take in 2026 to get even leaner.
So it's the price of future efficiency.
Exactly. It's an investment in a lower cost base tomorrow. But you can see why the market was skeptical when you say, we missed on revenue, but trust us, it's a tough sell.
Which is why management spent the whole call hammering this idea that they're at an inflection point.
They did. They basically declared the cleanup era over, and they pointed to 2 huge wins to back that up.
The first being the Fed's asset cap getting lifted, right?
Yeah.
That had been holding back their growth for years.
For years. And the second was the termination of 13 different regulatory orders since 2019. They kept saying this puts them on a level playing field.
And with that new freedom comes some massive new ambition. They hit their old target of around 15% return on tangible common equity.
ROTCE.
Yeah. And now they've set a new medium-term target of 17% to 18%. For listeners who might not live and breathe bank metrics, can you just quickly unpack what ROTCE really tells us?
Sure. In simple terms, it's just a core measure of profitability. It shows how well a bank is using its shareholders' capital to generate profit. And hitting 15% was already a huge achievement for them.
So jumping to a sustained 17% to 18%, that's a different lead entirely.
It really is. That puts them up there with the absolute best-in-class, most elite banks in the world. It's a promise of operational excellence.
So how do they get there? I mean, what's the engine for that kind of lift?
It's one phrase: operating leverage. They've already taken out $15 billion in gross expenses over the last 5 years.
That's a staggering number.
It is, and they're not done. They're guiding for another $2.4 billion in gross cuts just in 2026. And that comes from those initiatives that, triggered that big severance charge we talked about.
So they're taking the pain now for the gain later.
Precisely. They're structurally leaner. I mean, their headcount is down over 25% since the middle of 2020. That is the core of their entire argument. The costs are permanently lower, so any new revenue just drops straight to the bottom line and powers that ROTCE higher.
Okay, that makes sense. But leverage only works if you have something to leverage, right? You need top-line growth. What proof did they offer that they're actually growing again?
They pointed to a few key areas. On the consumer side, new credit card accounts were up 20% year over year.
That's strong.
Very. And auto lending balances were up 19%, which was helped by a really big deal they landed.
Oh, the Volkswagen and Audi deal.
That's the one. They became the preferred financing provider for them in the U.S.
Okay, but hold on. A 19% surge in auto lending. Isn't that an area where you'd start to worry about credit risk if the economy slows down?
That's the billion-dollar question, isn't it? Management insists it's quality growth. But they also pointed to the commercial side, where loans were up 12%. And their investment bank seems to be gaining real traction.
right? The IB fees were up 13%. But the one that jumped out at me was their M&A ranking.
Yeah, that was huge. They moved from 12th place in the U.S. all the way up to 8th in 2025.
Yeah.
That's hard evidence they're winning big, high-value deals again. It shows they're really back on that level playing field.
It's a great data point for the long-term story. But all of those strategic wins run straight into the big near-term problem, the thing that really spooked the market.
Net interest income.
Exactly. The 2026 guidance for NII.
Yep. They guided to around $50 billion for the full year, and that was just a bit shy of what the street was expecting.
And why did that cause so much concern? What's baked into that number?
It really comes down to the macro view. Their model assumes the Fed cuts interest rates 2 or 3 times in 2026.
Which compresses margins for banks.
It does.
Yeah.
So even though they're expecting decent loan and deposit growth, the pressure from falling rates kind of offsets some of that benefit. The market is basically pricing in the pain from Fed cuts.
I thought their commentary on the market's business NII was really interesting, though. It felt like a window into their new strategy.
It absolutely was. They expect markets NII to grow to about $2 billion. And that's not by accident.
It's a strategic choice.
A very strategic choice. It's driven by using their balance sheet for client financing in areas that have lower regulatory capital requirements. You'll hear the term RWA, or risk-weighted assets.
Right. So if the RWA is lower, you don't have to hold as much capital against the loan, which makes it more profitable.
You got it. It's a massively more efficient use of their capital, which they couldn't really do when the asset cap was in place. It's all about capital efficiency now, not just raw loan volume.
So let's go back to that loan growth for a second. We talked about the consumer side, the credit cards. A lot of those new accounts come with like low introductory APRs to get people in the door. That's lower margin up front, isn't it?
It is. It's an investment in the customer relationship. They're also growing in the non-bank financial space, lending to places like hedge funds. But they were quick to point out that those loans are typically secured and structured to be equivalent to investment grade risk.
So they're trying to grow, but in a structured, RWA efficient way.
That seems to be the playbook.
Okay, let's shift to capital, how they're returning it to shareholders.
Right.
In 2025, they returned a huge amount. $23 billion.
It's just a massive number. $18 billion of that was in buybacks, and they bumped the dividend by 13%, a huge sign of confidence.
But the plan is changing for 2026.
It is. Their main capital buffer, the CET1 ratio, is at 10.6%, which is just a little bit above their target range. So management signaled that buybacks will probably be lower this year.
And that's not a sign of trouble, right? It's a sign of something else.
It's a sign of options. Before, buybacks were one of the only ways to deploy excess capital. Now they can actually use that capital for organic growth, for those efficient, low RWA opportunities we were just talking about.
There was one other big cloud hanging over the call, though. An external risk.
Yeah, that proposed 10% cap on credit card APRs.
That feels like a direct threat to their consumer growth story.
It's a huge shadow. Management basically warned that if a cap like that came in, they'd have to pull back on lending to riskier parts of the population. It just shows that even when your internal problems are fixed, the external ones can still bite.
And what about overall credit quality? Any red flags there?
The main thing was an increase in commercial charge-offs, mostly from commercial real estate, specifically the office portfolio.
The office problem. That's not a news story.
Not at all. And management seemed pretty calm. They said valuations are stabilizing and any more losses should be well within our expectations. Basically, it's priced in. And importantly, consumer credit is still looking very resilient.
Okay. I think that sets the scene perfectly. We have the ambitious targets, the cost cuts, the regulatory freedom, all running up against these NII headwinds and policy risks.
A classic tug of war.
It is. Which brings us to our favorite segment. Not financial advice. This is where we take all this complexity and try to distill it into one speculative trade idea.
And the idea here is that the market is just suffering from myopia. It's obsessed with the next NII print, the next Fed meeting.
It's missing the forest for the trees.
Completely. It's missing the huge strategic shift that's happening under the surface. The cleanup is done. The operating leverage is real.
So the trade is a bet on that transformation story winning out over the cyclical rate fears. How do you play that?
We pitch a long-dated call spread on the stock. You're essentially betting that those $2.4 billion in expense savings plus the market share gains in the investment bank.
The M&A ranking.
Exactly. That all of that drives them to that 17% ROTCE target much faster than the medium-term guidance implies.
So you're betting on the efficiency story, not the interest rate story.
Precisely. If they hit 17% ROTCE ahead of schedule, the stock has to be re-rated by Wall Street. It'll trigger a major move up. And by using long-dated options, say 12 to 18 months out, you give that transformation narrative time to actually play out and be recognized.
It's a bet that management is right, and the market's current obsession with NII is wrong.
It's a compelling bet. I mean, they hit their 15% target and immediately raise the bar. That tells you something about their confidence.
It really does. Which I think brings us back to the central question from this whole deep dive. You have management saying they're on a multi-year growth path, targeting an elite 17-18% ROTCE.
While the market is stuck on near-term NII pressure and that potential APR cap.
So the final question for you, the listener, to think about is this. Given their goal of becoming best in class, how much risk are they really willing to take on to get from 15% to that elite 18% level?
Especially before the next economic downturn inevitably hits and forces them to pull back. That tension between the growth ambition and the risk appetite is going to define everything for them over the next few years.
A perfect place to leave it. If you have your own thoughts on that trade-off, let us know. We'll see you next time.